From a distance, everything looks perfectly stable, but step a little closer and you might feel the crack right down the middle. On paper, 2026 has been a solid year for the stock market. The S&P 500 is up 4.63% through late April, but that percentage is an average of 500 different stocks, and right now, those stocks are moving in two opposite directions. That headline number hides a deep split in the market. While companies building physical infrastructure are surging, the software giants that led the last decade are struggling to hold their ground. This chart shows how wide that gap has become. Centered here is the S&P's 4.63% return. But at the extremes, hardware makers like SanDisk skyrocketed nearly 360%, while software names like CoStar dropped almost 50%. This is a barbell market. Most capital concentrates at these opposite poles, leaving the index average feeling hollow. This leaves you with a choice. Do you cut lagging tech stocks and chase the hardware boom? Or do you hold on and buy the digital dip? In this environment, a broad index fund can obscure significant underlying risk. To protect your capital, you have to decide which side of this divide fits your strategy. The winners in this market share a specific trait. They deal in physical infrastructure. They aren't selling digital subscriptions. They are selling the hardware that makes the modern world run. Aggressive capital expenditures in artificial intelligence are pulling demand directly into the critical supply chain. Tech giants need data storage, memory, server cooling, and the power grids to support them. You can see the result on this chart. While the broader market stays near a flat baseline, the semiconductor index has climbed 46% so far this year. Investors are paying substantial premiums for these stocks because the demand is tangible. These companies have verified orders and a scarcity of manufacturing capacity that gives them pricing power. But entries here are sensitive. If those hardware orders start to slow, or if AI budgets are reevaluated, these high valuations could contract as quickly as they rose. Beyond hardware, capital is also concentrating in energy and industrial cyclicals. Rising oil prices have turned energy stocks into top performers. With Brent crude above $111, refining and oilfield service companies are seeing record highs. Adding these energy and industrial names to a portfolio can act as a macro hedge. They often move independently of tech volatility and offer a cushion against rising inflation. The downside risk here is geopolitical. A ceasefire in the Middle East or a sudden slowdown in global manufacturing could quickly reverse the momentum in these cyclical sectors. The market is currently rewarding tangible assets and manufacturing capacity. Pure tech investors face a sizable opportunity cost if they ignore the industrial and energy sectors. On the other side of the barbell, the bottom half of the S&P 500 is filled with names that used to be market favorites, specifically software and IT service companies. The data suggests that AI is not a rising tide for all of tech. Instead, the market is separating the companies that build the tools from the companies whose business models are threatened by them. For legacy software, AI can be a disruptor. It automates tasks that previously required human seats, which pressures pricing and limits the growth potential of traditional platforms. This quadrant chart illustrates the divide. Top right, hardware and energy feature high returns and earnings visibility. But look at the bottom left. Software, IT, and healthcare drop into the negative, facing low returns and low visibility. Healthcare is struggling with its own specific headwinds. Medical device makers and life science tools are dealing with a slow post-pandemic recovery and shifting regulations. The final group of laggards includes high-end consumer brands and travel companies. We are seeing clear signs of selective consumer fatigue. Shoppers are pulling back on aspirational brands, and investors are responding by moving capital toward companies with essential goods and stable margins. Buying these derated sectors requires caution. You have to determine if a stock is just temporarily out of favor, or if its business model has been permanently altered by new technology. A low price tag doesn't always equal value. Buying discounted software or retail names without clear earnings support is a high-risk move in this environment. Now that we've mapped the market, the next step is execution. You need to match your trading style to the side of the barbell that fits your risk profile. First, let's look at the momentum or relative strength trader. For momentum traders, the rule is to avoid buying into vertical climbs. Chasing a doubled stock is a recipe for a drawdown. Instead, wait for a pullback. Look for hardware entries only when they test rising 20 or 50-day support. This tactical patience helps an investor participate in the infrastructure boom without overpaying at a local top. Then there is the value hunter, looking for a mean reversion play. If you're bargain hunting at the bottom of the S&P, watch out for deceptive traps. You must pass one gate. Has earnings guidance stabilized? If yes, it's a reversal candidate like Adobe. If no, it's a value trap headed lower. Never buy a stock just because it's down 40% if the management team is still cutting their margin outlook. There is also a hybrid strategy for portfolio allocators, the pairs trade. By going long on AI infrastructure while shorting software services, you can profit from the divergence itself while neutralizing the broader market's volatile swings. Navigating 2026 requires moving past index-level assumptions. By diagnosing your trading style and respecting the physical versus digital divide, you can find the opportunities that the headline numbers are missing.